So the very first thing is, guys, this video right here is not for everyone. We're talking about grabbing absolutely all the money and putting it into one investment. And if that makes you feel squeamish inside and makes you be very scared, and if you can't handle a drop of 25% or 30%, this is not the video for you and you want to leave right now, okay? Because the whole point is this investment tactic is safe. It is super safe. However, though, it does have volatility. You will go up and it will go down. And it's like getting on a roller coaster. Everything is safe. Everything is fine unless you try to jump off mid-ride. And by the way, I want to tell you something. Just because this is not the plan for you, the answer is it doesn't mean that's a bad idea. Although this plan has the highest return possible, the idea is it is okay to follow a plan that might give you a little bit less money, but has the possibility of not having you take your money out all the time whenever you get scared. So this plan right here is only for those people that have, for example, a strong stomach, that understand the market, and have a long-term projection of the market, and will not get scared and sell everything whenever the market drops by 25% or 30%, which we will experience in our lifetime again. There will be more corrections. And as always, guys, do me a favor and basically like this video, and on top of that, also subscribe to the channel. We have a goal to hit 500K subs by the end of the year, and we have more content coming out on more stock investments and actual individual stocks to actually buy. Now, the very first thing is this, okay, guys? Most of the people that started watching this video already left because this stuff can be very scary. But in reality, the very first thing, guys, is I want to show you exactly the way I used to invest versus the way I'm going to start investing now. Now, by the way I used to invest has made me about $25,000 in this one portfolio. And you might say, Tommy, but 25K, that's a good profit, but it's not a good profit when you compare it to what I could have made, which was about $107,000. That's 4 times my money, okay? And whenever I think about that number, I'm like, yo, that's kind of crazy. And by the way, I don't regret it, because at the time, that's the portfolio I needed because I was a very amateur investor and I could have potentially sold everything if I would have just followed this strategy right here. So again, it all depends on your stomach, your mentality, and also your projections for the future. Now, let me show you over here exactly how I used to invest. So this right here, guys, is my M1 Finance portfolio. And as you can see, I have about $253,000 invested. And overall, I have a $14,000 deficit right now. But in reality, it's not a real loss because when you go to my holdings, you see that I'm still up around 11%, which means around $25,000. Now you might say, Tommy, well, this investment strategy has been making you money. What's the big deal? Everything is fine here. But when you take a look a lot closer, for example, you're seeing that the overall gains have been, for example, from the Vanguard S&P 500. Now, this is actually very important. But before I get to that part here, I want to show you guys something. As you can see, I was investing into 5 positions. I had money in the US, money into small companies, money into developed markets, for example, outside of America, internationally, money into real estate, and also lastly, money into emerging markets. Now, this portfolio had one goal in mind, and the goal was very simple. It was to basically make sure that whenever one part of the market basically went down, another one went up. Same thing vice versa. So this way, I wouldn't get scared out the market whenever the market had a big loss because I would never actually see that big loss because my portfolio was spread in a way where I didn't have to worry that much. Now, it got to a point, guys, I gotta be honest here, that even before I started doing this portfolio, which by the way, only 5 positions. I had one with 7 positions where I had, for example, corporate bonds and treasury bonds. And by the way, this just means I had some of my money that was going into, for example, lending money. And when you lend money, you don't share in the growth, you only get paid your interest. And in reality, when I did the research, I found out that basically holding my money into equities, for example, into stocks and stock ETFs and index funds, is going to basically outperform those bonds. So I said, yo, this doesn't make sense. I got rid of those. And now that I'm learning even more, I figured out, yo, this portfolio has returned for me a very good gain and it keeps me from jumping off the roller coaster. But now I know the roller coaster. I know what's happening here. So there makes no sense for me to actually have these investments. So overall, what is this new strategy? And by the way, just to show you guys here one last time, here are my 5 investments exactly. If you click the link down below to M1 Finance, you'll still see these 5 investments. This portfolio is for someone that basically wants to invest for the long run and basically wants to make sure they don't see, for example, steep market declines because they basically can't handle it that much, okay? So a great portfolio, it earns you a decent return. It has, for example, a decent dividend also. It's great stuff. It's not bad stuff. It makes you money, obviously, and over time, you're gonna make money either way. However, though, Tommy, what is this new strategy? The answer is very simple. We're gonna grab all the money and put it, for example, into one investment. And that one investment is going to be the S&P 500. Now, I know this sounds kind of crazy because it sounds like, Tommy, just all of your money into the S&P 500, isn't that more risky? Isn't it less diversified? Well, in reality, first, that would have made me around $100,000 instead of $25,000. It's a big difference, okay? Second, if you're investing your money into 500 large companies in the US, they always move around. If a company, for example, doesn't earn that much money anymore and loses its size and position, there's a new one that comes in. So in a way, it's kind of like random in a sense, if you think about it. But in reality, you are diversified. You're investing into the entire basically market in the US because these are the largest companies in the US, thus also the largest companies in the entire world in a sense. So you are diversified. It really doesn't mean, for example, more risk. The big thing is, because you are invested just into the 500 largest companies, whenever the US takes a hit, you will feel it and you will see that volatility. So overall, what would be the pros of me putting all of my money just into the S&P 500? Well, first of all, you have simplicity. You know, this portfolio right here of having 5 ETFs or whatever, it's great. It's not that complicated because M1 Finance makes it easy. Whenever I invest $100, they grab this money and put it exactly how I want it to be put in. But in reality, for a lot of people out there that hold different investments, it's a lot more complicated, okay? That's the first thing, simplicity. Second thing is, guys, because you are investing into just one investment here and you have, for example, less diversification, the gain is going to be larger in this case because we're using, for example, the historical data. So $10,000 invested into the S&P 500 50 years ago would have had, for example, a total amount of $1.5 million. To me, that is impressive. On top of that, guess what? When you only have one, guess what that means? That means also less fees. Although index funds and ETFs usually have, for example, very low fees. Well, when you only have one, that's also a reduction in fees by a lot. And by the way, I only pay around 0.03% as far as an expense ratio, but only paying on one, that also makes a big difference over the long term. Now, those are basically the pros. The pros are simplicity, more money, and on top of that, you also pay less money in fees. That's the idea. But the cons are very, very simple and specific, okay? The cons are, first, you have volatility. But volatility exists, for example, with all investments. And volatility does not equal risk. And that's a big problem with a lot of people, okay? Because the idea is, if you're buying something and you know that over time you're going to be putting your money into it, you're going to be doing dollar cost average, which basically means, hey, I'm going to invest the same amount of money over a long period of time. So that way I invest when the market is up, when the market is down, and I get the average over time. And on top of that, I'm going to make sure I don't sell off during down markets. In reality, you're going to be just fine. But because you have volatility, which basically means, hey, sometimes it's going to be up, and it's going to be down, up, down, up, down. It doesn't mean it gets more risky. It just means basically the price is changing. It doesn't mean necessarily that the value is changing. We have a bunch of corrections all the time, but overall, the market has recovered from every single downturn, every single one. Now, on top of that, another con is basically this requires a lot of faith. Faith in what, Tommy? Well, faith that it's kind of funny when you use words like that, for example, when it comes to investment, but faith, for example, that over the next 50, 70 years, that American business is still going to be doing very, very good, and that the world is going to be still doing a lot better. Now, the only way we kind of lose in a sense is, for example, if we have like a big war, nuclear, biochemical, whatever it is, and then you have like a big issue, but even then, like everything is going to be messed up in a sense. So that's kind of like, if that happens, well, that happens, but overall, it doesn't take away that everything here is just going to be messed up. And the last con is that this does require consistency. For some people, it might be easier to invest when the market is up than when it is, for example, when the market is down, but that's when you should feel more comfortable investing. And one thing I always do is this, okay? I might have a plan as far as like, hey, I'm gonna invest 10 to 15 to 20%. I pick one and I do that forever. But then, for example, if I'm experienced like a down market, and my portfolio is down by like 15% or 10%, I might go ahead and throw in some extra money in there because I know, hey, I'm buying at a discount. I'm buying at a discount. And I did that back in March of 2020. And that's why my portfolio is so up so much, because I bought basically at the bottom, okay? Because I knew, yo, the market is down 25% or something like that. Like, do I really think America's done over this? The answer is no. So overall, I put more money into it. But a lot of people were scared and they were selling because whenever I'm selling an ETF, guess what? Well, whenever I'm buying an ETF, someone is basically selling, okay? So it's always a transaction here, okay? When I buy, they sell. When I sell, someone's buying, okay? That's very interesting, huh? But overall, that's the big idea, guys, okay? So you will be a lot better off investing your money, for example, into the S&P 500 if you have the stomach to sustain it. However, I will say this is not for the average person. If you do experience a decline of 25 to 50%, you have to be able to stay consistent and keep investing money for the long term. And I know this sounds like, yeah, Tommy, this stuff is easy, okay? It's just buy the dip. But when you do that and you only have one investment, it feels a lot more different. That's why it's so important that you increase, for example, your risk tolerance by, for example, only investing when you're debt-free, having a full-blown emergency account, and while you're investing, working on paying off your home at the same time. So this way, if you have all three of these things basically completed and done, well, your cost of living is so low and you're only investing 20% of your money, so you feel a lot more comfortable basically putting your money into that and waiting for the long run, okay? That's the idea. Now, to put this into perspective, let's say you're about 30 years old and you're gonna start investing with $500. And every single month thereafter, you're gonna put in $500 to max out your Roth IRA for the next 30 years, okay? And you're gonna make somewhere around like 11.89%, which has been, for example, the average return over a long period of time, about 70 years or so. Now, this means that basically after this 35 years of investing, that amount would turn into somewhere around $2.8 million. While, for example, if you had a normal portfolio that made you about 8%, annualized, well, that would only be around $1.1 million. The difference is literally $1.7 million, and that makes a very big difference, right? So you see what I'm saying? Like, you can have one portfolio where you don't experience all the downside all the time, and you can have one that you experience everything, but by doing all that stuff and just sticking to the course, you kind of say, well, I'm going to have a much heftier return overall. So this plan, honestly, is for someone that has a long-term perspective and will continue to invest no matter what and has a stomach to actually handle it. And that's not everyone. So my big thing is, Tommy, well, are you going to sell all your other positions and basically just move into this plan right here? The answer is, what I'm going to do is I'm going to sit down with my accountant this week and see how we're going to carry over the losses from the ETFs I basically have to basically help me out with taxes, because that's always great. And I'm probably, yes, going to do this plan. But one thing I always say, guys, okay, if Dave Ramsey probably saw this video, he would say, it's not that he's wrong, is that, for example, for the average person, they wouldn't be able to handle a plan like this, because putting your money just into the S&P 500, although it makes sense if you believe, for example, in the American future, it is a lot more risky that you might not continue the road of investing if you experience all this volatility and you're not able to comprehend it and to actually keep investing throughout the whole thing. That's the big idea, okay? But guys, that is it for this video. Comment down below. Let me know what you think about this plan. And on top of that, comment down below stock so I know you made it all the way through. And up here is another video. Over here is my face. Please subscribe. And as always, Long Term Team officially out.